Tēnā koutou e te whānau, no mai hoki mai. It's a pleasure to join you here for today's Tax on Tuesdays session. I'm going to be your MC for today. My name is Edward Miller, and I'm a member of the Tax Justice Aotearoa Policy Advisory Committee. I've got a background in the labour movement, both in Aotearoa and more broadly around the Asia-Pacific region. And for my current mahi, I'm a researcher at an organisation called the Centre for International Corporate Tax Accountability and Research, or CICTA. We generate tax and corporate research to help drive union and community campaigns to get a better understanding of the policy and financial background against which they're working. Welcome to the second in Tax Justice Aotearoa's Tax on Tuesdays series about our tax policy statement. This session focuses today on the topic of trusts and tax, which is actually a really important issue here in Aotearoa, New Zealand. We have an exceptionally high number of trusts per capita. We have an exceptionally low number of taxes. We have an exceptionally high number of trusts per capita. Later in this series, we'll be looking at other issues like the TJA policy around wealth and wealth transfer taxes. We'll be looking at corporate tax, including taxing multinationals and taxing big tech. And we're going to conclude with a discussion on, or a session rather, on how New Zealand's current tax settings and our Tax Justice Aotearoa policy positions compare to other countries. So today, we're going to start off with me saying a few words about why Tax Justice Aotearoa decided to develop its tax policy statement, what the function of that document is. We're then going to bounce to our Tax Justice Aotearoa Policy Advisory Committee member and tax expert, Terry Baucher. He's going to talk about some of the problems with the way in which trusts operate in this country, particularly with regards to tax, and some of the reforms that TJA has put forward and would like to see implemented. This should be around about a 20-minute Q&A session back and forth with me as the MC, and then we're going to jump to our other esteemed guest, Professor Jonathan Barrett from Victoria University to Herenga, Waka, on what he has heard from Terry, what he disagrees with, how little he likes trusts, and what he thinks should be happening in this area as well. And then there's going to be an opportunity for questions and for you guys. So please, as we're moving through the discussion, anything that pops into your mind, please drop a question in the chat or a comment in the chat. This is tax. There's no such thing as stupid questions. It's all about just getting a better understanding of the system and to try and work out how we can make it as fair as possible. And we are going to wrap up the session by 1:30 at the latest so you can get back to planning your trusts and working out how to distribute your assets. Just before we start, I'd like to remind everybody that Tax Justice Aotearoa is the lead organisation in the Better Taxes for a Better Future campaign. That campaign is supported by a coalition of around 25 organisations and is campaigning actively for a tax system that will enable us to gather the resources that we need to fund the things that matter to all of us and to do it in a way that is fair for all of us, particularly our most vulnerable. So for those who haven't already, we'd love you to get involved. Support this mahi. We're going to put some links in the chat. I can see them popping in there at the moment for you to sign up and donate. And I'll remind you at the end of the session about that as well in case it slips off your radar before you get back to your own tax planning. Let's get on to the tax policy statement. So the tax policy statement was released in April this year, and it sets out some policies for reforming our tax system and builds on a set of principles that undermine this approach. That most importantly is that we need more revenue to ensure that the government can respond to the challenges that we're facing at the moment: poverty, inequality, climate change, aging population, infrastructure deficit, struggling public services, etc., etc. We need more revenue to be able to pay for all of those services and assets, and we need to be able to gather that revenue in a way that is fair, in a way that ensures that those who can most afford it are paying the most, and that addresses the impact that the tax system has on the least well-off, our most vulnerable communities. It also works from the principle that tax can change behaviour. It's important in areas like public health and the environment, but that again needs to take into account the interests of the most vulnerable, and that transparency is an essential part of a properly functioning tax system. These principles have provided a framework for our consideration, and we've put together this set of policy positions. It provides a benchmark against which we can assess tax policies of the political parties and other interested groups, but it is a living document. It's not the final word on tax, and it is evolving over time, just like our tax framework is as well. So that document is around. I think there's links to it in the chat, and it's part of opening up a discussion for us with various members of the community and the tax community about how we can use tax to better our society. So I'd now like to introduce our speakers. We're going to be chatting first of all to Terry Boucher. Terry is the Managing Director of Baucher Consulting, the tax consultancy, and he's also the host of the esteemed podcast Te Wiki o Te Tāke, the New Zealand tax podcast. Terry has been working in tax for over 40 years now. He started in 1984 with Her Majesty's Inspector of Tax in the UK before moving to Aotearoa, New Zealand in 1993, and we're grateful that he's here. Terry was a member of the 6th Labour Government Small Business Council, which met between 2018 and 2019, and is an active contributing member of the Policy Advisory Committee of Tax Justice Aotearoa. So thank you, Terry, for joining us, and we'll jump into a couple of questions for you in a moment. We've also got Jonathan Barrett with us. Jonathan is a professor in taxation and commercial law at Te Herenga Waka, Victoria University of Wellington. His research specialty is taxation and human rights. He's currently the president of the Australasian Tax Teachers and Association, editor of the Journal of ATTA, and the guest editor of the Journal of Australian Taxation. Thank you, Jonathan, for joining us, and we look forward to some enriching questions to Terry and discussion starters. So, Terry, I'm going to start with you. We're going to talk now about trusts, your views on them, and how that has helped form the Policy Advisory Committee. So, start us off. What the heck are trusts? I thought they were just a way of getting a bit of healthy competition between your children and your grandchildren, but apparently there's a little bit more going on here. How do they operate? Why are they important to us? And why are they important to our tax system as a whole?
Kia ora, tāke, Edward. Thank you so much, and welcome along, everyone. Pleasure to be here. Right, big question. First things to first is a trust is a relationship between three groups of people. You have the settlor, sometimes called a grantor, and this is a person who settles or gifts property on trust. Now, it's managed by the second group of people, trustees, and they have a trust deed, and they manage that property for the benefit of the beneficiaries. So it's a relationship between the settlors, trustees, and beneficiaries. Now, trusts legally do not exist. There's no such thing as a trust in law, but all assets are held in trust by the trustees. So if you ever look at companies' office records and you see that a shareholder is named as the ABC Trust, that is incorrect. It should be the trustees of the ABC Trust who's named there. But for tax, they are a separate entity. And that's where start with the starting point for our discussion, because tax recognizes them as separate. Now, trusts have been around for centuries. They're intergenerational assets. And that's primarily how they existed, as a means of passing property safely from generation to generation. They've come and gone in waves, but they're typically used in most jurisdictions, use them, and New Zealand was no different around intergenerational succession planning, because the assets held in trust are legally separate from the settlors, which means that, as I said earlier, for tax purposes, they were outside that person's estate for estate and gift duty purposes, without getting too technical here. But they were very primarily designed around intergenerational distribution and succession planning. Now, critical thing to say, as I said, there's three groups of people involved: settlor, trustees, and beneficiaries. Now, the way New Zealand trust law has evolved in the last 35 years since the abolition of estate tax in 1992 is that it is common for a person to be a settlor, trustee, and beneficiary. Most other jurisdictions don't allow that. They don't see that as a valid trust. Many people can be the settlors, they often are, and maybe the trustees. They can manage it, or they can be the settlors and beneficiaries, or just simply trustees and beneficiaries. But in New Zealand, the laws developed that we have allowed essentially one person to be all three. And I've been at a number of trust practice conferences down the years, and overseas practitioners do give us a bit of a side eye about that, because that seems a little bit too convenient. And there is a whole case of law about whether in fact those are sham trusts, ghost trusts you might call them, and whether in fact there has been a legal separation of property. Won't go into that at this point, but it is something unique, and it is one of the reasons why, and I'll show you some stats in a few minutes, about New Zealand's extraordinarily high number of trusts relative to that. Now, why does this matter for tax? Well, for tax, a trust is treated as a separate person, and so they have their own tax rates, etc. And most trusts in New Zealand are what called discretionary trusts. Won't get into the technicalities of something called interest in possession trusts, which specifically say this person will get 1/3 of the income, 1/3 of the assets. But most New Zealand trusts are discretionary. In other words, the income and capital is distributed at the discretion of the trustees. Now, if you start thinking about this, how does that work? So I'm going to share a screen and show you how this works for tax purposes. And where is screen sharing? Can't see it.
Should be down the bottom in one of the...
Ah, there we are. Sorry. Apologies. Right, so what you have here is, this is how a distribution to trust beneficiaries might work. So we've got a trust here, which has got $30,000 of income for the year. And it decides it's got three beneficiaries who are all at the lowest personal tax rate, 10.5%. So it will distribute all that income to them. The trust is responsible for paying the tax, and the tax on that, 30,000 at 10.5% is 3,050. Might have got my maths wrong slightly there. If the tax to trustee income, which is the standard rate now, is 39%, the tax on that will be $9,900. So you can see here that the use of this trust can save a substantial amount of income for the trust. So this is one of the issues we have with tax planning around trusts, that it is possible for trusts, those to distribute income, which for most people would be taxed at their marginal tax rate, 39%, or would be, but instead they're able to tax it at a lower rate, 10.5%. As you can see by this example, the amount of tax saving can be quite substantial. And this is actually common practice. This was common practice amongst trusts and beneficiaries before the trust tax rate went up to 39% with effect from 1st of April 2024. And there are some massive numbers potentially involved. We'll talk about further. We don't actually know a lot about what income, or rather, how much the composition of income and the number of trusts and have and the total wealth within that. But we do know, according to reports that in the tax returns filed for the year ended 31 March 2024, the trusts received $47.3 billion of income in that year. They reported that amount of income. 86% of that was treated as trustee income. That's over $40 billion. In other words, it was taxed at the then rate of 33%, rather than being distributed out and potentially taxed at 39%. So at a rough rule of thumb, if all of that had gone out to people at 39%, that's $2.4 billion of tax that was saved through trusts. So this is why we get look at trusts and their use in tax planning, and why it is concern for in terms of potential abuse, if that's the right word. I mean, there are valid reasons for using trusts. They're not automatically tax planning devices and tax avoidance devices. For example, if you've got beneficiaries who are not differently abled, then their trusts are perfectly valid for them. Or they've got lack of capacity, dementia. That's an increasing issue I see now, and need care. Again, trusts are useful tools in that regard. So it is not a question of the sort of quote, oh, well, four legs good, two legs bad. All trusts are bad, full stop. They all have their place to play in them. But we do know, and this is what drives the tax policy statement, is there's a significant amount of wealth in tax, and there has been some significant planning and tax mitigation, for want of a better phrase, used around that. Now, Eric, when you called you Eric there, Ed mentioned earlier about the number of trusts relative in New Zealand to other jurisdictions, and we've said per capita we're amongst the highest in the world. And this next slide gives you an example. I came across this by accident. I came across a statistic that HMRC was saying that they had received only 120 odd thousand tax returns for a year, and I thought, wow, that is considerably less than ours. So I then dug out these stats, and if you can see them here, for the year ended 31 March 24 for both the UK and New Zealand, the UK had 157,000 trusts filing tax returns. We had 233,000. So in absolute terms, we had more. And that's another 200,000 trusts at least that don't file tax returns or regarded as dormant. They probably hold just the family home or maybe the family batch. Canada's December 31st, 2023 shows 377,000 odd. Australia has over 1 million, and that's for the June 2023 period. And in the United States, the December 22 period shows 3.2 million. Now, you convert that to a per capita, this is what you get. We have 23 persons per trust here, 26 in Australia. Even the Australian Tax Office recognises that we have some more. Then America and Canada, roughly similar jurisdictions, unsurprisingly. You can see about 105, 108. And then Britain, the home of trusts, that's where the trust concept of trust law was developed under English law, 441. So quite a dramatic difference. Now, 4 of those jurisdictions have estate taxes or capital gains tax. Australia and Canada don't have estate taxes, but they do have capital gains taxes, and they do charge trusts that dispose of assets will be subject to tax. The US and the UK have an estate tax and inheritance tax separately. Now, if you recall what I said earlier, trusts are most commonly involved and developed as intergenerational succession planning, and that's why most trusts are there. But as I mentioned earlier, we got rid of trust or estate tax or estate duty in 1992. But here is the really interesting thing. You can see the red line here shows that's when the estate duty was repealed. But you can see the number of trusts that are settled takes off after that period. And that's tied into what I said earlier about about the fact that we could now allow a single person to be a trustee, beneficiary, and settlor. And this enabled people to basically transfer assets, yet retain control, which is not really what's meant to happen in trusts. So this is one of the reasons we are such an outlier in this space. So that is, in essence, a quick stop on the on our trusts, on the matter there, and why they are a significant part of our tax system, and what issues they arise out of that.
Yeah, thanks, Terry. So you've walked us through some of the data there as well, which is extremely helpful. The tax policy statement.
Sorry about that.
No, fantastic. It was super helpful. The tax policy statement calls for a three-pronged approach for improving the tax treatment of trusts. The first measure that you're calling for is a big jump in transparency, and that really relates to that data that you were just walking us through. Can you walk us through what the measures you think need to be put in place, and what do you think would be the outcome of those measures if we implemented them here in Aotearoa?
Well, 2 things we're looking at here is one of the things that stands out for from New Zealand perspective is the lack of detailed tax statistics that we have available. And tax policy is driven around statistics. You don't know what you don't know, but when you do know, you can then drive and properly plan and devise policy to around that. So one of the first things we are seeing, and to be fair, this is already happening. And there are two reasons for driving it. And firstly, Inland Revenue is now expecting a lot more data from trusts. And trustees have to do a lot more reporting. So we have more details about the type of income that's being reported. So, for example, from 2020, we now know the total amount of net residential rental income devised by trusts. And the number there is a lot less than you might think. It's only $1.1 billion in the year to March 2024. But that sort of gives us an indication of where assets are being held. And that's all this drives equality. Now, coincidentally, this ties in the enforcement, or rather increased action from Inland Revenue wanting more statistical data, coincided with the implementation of the Trusts Act 2019, which took effect from 30th of January 2021. Now, what that did was consolidate a whole pile of law and modernize the trust law, but more importantly, it brought to codified what were responsibilities for trustees in terms of what information they could divulge or were required to divulge to beneficiaries, and previously they didn't have to tell. They just, with a discretionary trust, they didn't even have to tell them that they were even a beneficiary. And if you have a look at some of the separation and family law, matrimonial property disputes, I'll get there in the end, relationship property disputes, many cases, it sometimes popped up that one party did not know that assets were held in trust and that they were or were not a beneficiary. And so the Trust Act set out more clearly that trustees were expected to provide reasonable information to beneficiaries. They could still decline it. You wouldn't want to let your drug addict beneficiary know that the trust is worth $5 million because they'd be pressing it. And that would be a valid reason for declining information. This follows international trends on cases, and even the jurisdictions like Jersey have been found to have to divulge information. So we're now starting to know more about what happens. And so that's leading to a consolidation, because people are suddenly realizing that it's actually sometimes better, if you want to keep things quiet-ish, to actually have stuff in your own name rather than through trust, where a beneficiary might say, hey, am I a beneficiary? And B, can I see the trust accounts? Now, that's one move. And the other move is a trust register. Now, trust registers are somewhat controversial, because the question is how a question of privacy. French Constitutional Court, for example, knocked back a proposal to have a trust register in France. They don't actually have trusts per law, but they do recognize them under that. Britain has its own trust register. Now, you recall earlier I showed a stat showing that the number of tax returns that were filed in England for the year ended 31 March 2024 was 157,000. Under the trusts register, which requires any trustees holding property in the UK or potentially liable for tax in the UK, mostly relating to property, they're required to register. But quick questions popped up about testamentary trusts. Thank you, Stephen. Testamentary trusts are pretty much the same as inter vivos trusts. I've been talking about inter vivos trusts, but those stats I've been talking about do include testamentary trusts. Thank you for that question. I meant to make this clear. Sometimes testamentary trusts, by the way, and pardon me for the digression, but it's a good question. I might as well deal with it here. Sometimes they are more specific about what's to happen. You may recall I mentioned earlier that there is something called interest in possession trusts. And those are trusts actually which specify that the income is in specified amounts. So the person has an interest in possession to say that you will receive 1/3 of the income, and on my death, or you will receive, or on another event, on an event, you will get 1/3 of the capital. That's a testamentary trust they're earning, but most testamentary trusts in New Zealand do tend to follow the discretionary line. That said, what we tend to see, to be truthful, and cover this off, is that the will tends to dump, if there's an existing inter vivos trust, i.e. created during a life, we tend to see the will pass the assets into that testamentary into that trust, rather than create a separate testamentary trust, or estate as they're sometimes known. I hope that answers your question, Stephen, but thank you. It was a good question. So now, coming
Terry,
back to, I was
you
just going to quickly finish off the point I was going to say. In the UK, the difference was we had 157,000 trusts filing tax returns, but we have over 700,000 trusts registered in the UK. So you can see the difference here. We don't know how many trusts we have in New Zealand. Estimates range up to 600,000. Many of them may be holding just the family home, the family batch, etc. So transparency around where things are held there is one big step forward, and that leads on to the second step. Sorry, Edward, after you.
You were talking about the idea of a trust register. I was just wondering, what would that look like? Is it going to be just like the company's register, where you can log on, see who the trustees and the beneficiaries of a trust are? Are you going to be able to see what assets are inside it? Is that going to start to eat into some of the rights of the beneficiaries and so forth?
This is the key design question, and the amount of the limits. It may be simply that the asset, more a question of showing that the assets that they're assets held in trust. And I think particularly in relation to property, this is what probably matters more than anything else, where people are dealing with property or dealing with businesses, for example. I think this is going to be important, that sometimes you have trustee shareholders, or you have occasionally something called a trading trust, which may not appear. So those are the sort of things where you disclosure, because there's relevance for transactions happening. Disclosing directly down to the beneficiaries, etc., particularly when you've got discretionary beneficiaries, probably is a bit of an invasion of privacy and could lead to a whole pile of mischief. So these are very difficult design questions, but it's really establishing who owns what of significance. And you probably have a threshold above this. We haven't actually finalized that number there. I think we talked around 100,000, maybe higher, on this question. But I think real property needs to be, people need to know that it's held in trust, and at least be able to track down who are the trustees. Yes, John Canton is a far greater tax consultant than I am. Hi, John. Has made a very good point. It probably just registers showing that there is an interest in trust, maybe enough. Certainly that those are a step forward in the right, that would be a step forward in the right direction.
But some form of transparency
Yes.
measures, which starts to bring some of the put some contours around the picture that we're dealing with here, so we can start to address the question of, how wealthy a country are we, and can we afford to fund the public services that we need, and what's the contribution of the trust sector to doing that. And I wanted to move that into the next kind of policy proposal that's come out of TJA, which is for an intergenerational levy on assets above a threshold of $5 million held in trust. I mean, you were talking about the abolition of the estate tax in 1993. How would this intergenerational levy on assets work? What's the purpose, and what kind of revenue do you think it would be able to generate for New Zealand?
The intergenerational transfers is a massive issue, but the largest intergenerational transfer in history is happening right now, from the baby boomers down and the Generation X. There are trillions of dollars involved all around the world. And the question around this is, we do not have any mechanism where there's a taxing point on this transfer. We don't have a capital gains tax. The Australia and Canada and South Africa all deal with that point by way of a capital gains tax on assets passing down. But you don't want to be the question is the inequality wealth inequality starts to get cemented in and starts to become generation. We're starting to see that. We have billionaires inheriting billionaires, becoming billionaires by inheritance, and that's probably going to multiply given the colossal amount. And so the idea would be that there would be a wealth charge. Essentially, it's a wealth tax charge, and maybe it's a one-off, or variations on this exist. I'll stick, for example, in the United Kingdom, they have an inheritance tax. And they have something called a 10-year charge, which means that assets held in trust are revalued every 10 years and treated as if a lifetime transfer for inheritance tax has been made. That works out as a 6% tax charge on the value at that time. Canada have a 17-year rule where all assets held in trust are deemed to have been disposed of and reacquired, and that ties into their capital gains tax. So the question is, we've got this, we're allowing wealth to, it's another means of raising funds and revenue on that. And increasingly, what we're seeing is that most of these estate taxes, they raise maybe 1% of GDP, perhaps, which in our case would be $4 billion. We don't know what we don't know what we don't know, but best estimates are there's possibly well over $500 billion in trusts, probably more. It's one of the quirks that people perhaps do not accept easily, that New Zealand actually per capita rates consistently through the bank, the UBS survey and Alliance Commons, another German giant bank. We rate consistently in the top 5 wealthiest countries, certainly a top 10 wealthiest countries per capita, and frequently pop into the top 5. And you made a good point earlier. We're actually on a median wealth. Our median wealth is quite low.
We're fourth on
median wealth, which means our wealth is quite well spread.
Yeah, well, amongst the wealthy, it is probably quite well spread. I would say in some of the countries that have higher average wealth and lower median wealth, they would have more extreme wealth concentrations. We have lots of wealth that is held and is kept generationally passed on from one layer to the next. And that means that we have a whole group of people who are relatively well off compared to some of the others in this country. And that's why I think the proposal for an intergenerational levy on assets probably could serve as some kind of a resetting device in some measure, not as a permanent reset, but could have some kind of redistributive impact. Another point, trusts have both legal and tax benefits. And Terry, you've spoken about how there's value in maybe separating these two off from one another. So you have the legal and the trust and have the discussion separately on a policy basis. Can you walk us through that and what you think this might achieve?
Right. On the tax side, a big step forward is there are 2 prongs to this. Tax transparency. We measured this intergenerational levy potentially, which, just to tie up, we are meeting some huge demands coming forward, as you mentioned earlier. I mean, south of Otago just got battered by a storm. There's more rain coming into as I speak in and around to the Nelson Marlborough region, and so these involve colossal sums of money to mitigate, and we're not spending much on mitigation at the moment. We're spending a lot on repairs and reactive, but we're going to need to start thinking seriously about moving in there. So that's one reason it'll be needed. But just a quick aside, by the way, way back when, before the first national government was elected, capital taxes represented, such as land tax, and we had one, stamp duties, estate duty, gift duties, and various other duties, they added up to nearly 5% of the government's revenue of the time. That's a hell of a lot of money. As I said, typically though, when you look around other countries, it comes down to about 1% of GDP. $4 billion of extra revenue, so to speak, would be starting to make a difference on that. Now, as I mentioned, that's the tax side. So the tax side is now on there. We don't know the stats to see what happened in 2025. We'll see those in September, by the way, as to how income was allocated and taxed. John Canton made a good point. It's an assumption, assuming that $40 billion would have been taxed at 39% is a bit of a stretch.
Mm.
But that's to just use that number to show it potentially what the option, what potential leakage could be at its worst case. We're probably going to see that drop down a bit. But legally, as I said, there's these questions. What do you do? And this is going to be an increasing issue with elderly parents. So our population ages are going to see more issues with people going to be in care with dementia. That's something of real issues that I'm encountering right now. People with millions and millions of dollars of assets in lack of capacity. So trusts are handy there as a means of managing those wealth and making sure that something doesn't go terribly wrong. Because older people are also, and this happened to an elderly relative of mine, exposed to scams. There's frauds, etc. So this separation is already starting to happen, and we're starting to. So if you'd like to put it this way, in 1992 we went off in a slightly different branch from the rest of trust law, and we got fairly loose and ready, and that's why we've got so many trusts in there. But the rest of the world, trusts are very regulated. There's a long established history and management of that. And we're sort of now, because of the Trusts Act, and we're coming back to that, and people are starting to realize that there are valid reasons we want to have trusts. And I'm also dealing with cases where people are just saying we don't need these anymore. So there's a drop in trusts as they be disestablished. For example, the number of trusts that Inland Revenue is now seeing tax returns has started to fall. And that's because people don't need them. They realize they no longer serve a purpose. So we can do that. I think part of this is going to happen naturally, and we will gradually, people will realize that. I think other things is, and this is a bit of, well, this is a bit too expensive for our liking, is that now that the Trusts Act has come in and basically is expecting trustees to lift their game in terms of administration, people are saying, well, this is costing a lot of money, and what are we actually getting out of it? And so maybe we should just dissolve the trust. And that's genuinely, I come across and advise clients to do that.
The administrative costs are getting higher than the tax benefits.
Yes. So that's how it was steps. I think the main thing in terms of the tax thing, the first stage is aligning the top tax rate to the trustee rate with the top tax rate is a big step forward in terms of dealing with tax mitigation. And Jonathan and I talked about this a long time, for a long period, and you can show stats. You can see where there's potential income was sliding potentially out of tax net.
I think that's a really great opportunity now for us to bring Jonathan into the discussion. Professor Jonathan Barrett, if you could come in. You've got some quite strong feelings around trusts, I think. Would you like to share what you're thinking in any
Yeah, I mean, kia yeah, if you're hoping I was going to disagree with everything Terry said, I'm afraid I'm going to add a little nuance rather than disagreement with this. Just a couple of points that Terry made, which I'd like to add to, is we very often think of the Revenue Service as a collection agency. Or the collection function of a revenue service is actually the third function. The first function is to collect data. The second function is to assess, and the third is to collect. And that's where we're lacking. And it's very easy to oppose progressive tax propositions when you don't have the data, and just say we don't have the data. So I think that's absolutely critical that Inland Revenue has the powers. Unfortunately, David Parker Singh fell by the side, but has the powers to collect that information that would enable coherent and informed policy. So that's one aspect to it. The other is in talking about legitimate use of trust. Terry raised the one of the disabled child, and I think that is an important one. And then at the end, raised the question of people with a lot of assets going into or suffering from dementia. But we do have a public trust. We could bring that institution up to scratch, properly fund it, and make that the body rather than having this flood of trust going through. So I think that's there. Mostly trusts, though, I think are actually quite pernicious vehicles. I mean, we have this history that they were there when the knights went off on their crusades and all of the rest of it. They've always been involved in avoiding some other legal obligation. And that's the one that really concerns me is, first of all, we have the tax aspects, and Terry explained that very well. We then have questions such as maximising residential care subsidies. If you have the good sense to get in trust and you can get that, that's quite significant. Student allowances. There are plenty of students getting allowances when their parents are sitting on huge portfolios of property. And then there's the other one, which is asset protection. And we often say, oh, it's only an asset protection trust. But what is it actually doing? It's actually removing money from potential creditors. And that's one that really does bother me, because we're starting to see at last some prosecution of directors of companies in things like the Health and Safety and Employment Act, the Resource Management Act, Fair Trading Act, etc. If their assets have been squirreled away in a trust, the rug's pulled from underneath that. So I think the broader aspect to it there is really, really important. The other thing is, if we start progressive tax proposals coming through, like we're doing here, any sort of tax on capital, wealth transfers, trusts are going to be in there in the mix for sure. Even now, the government hinting at the possibility of asset testing or means testing superannuation. If the capital's tested, again, trusts are going to be there, reducing that liability. So my proposal is really that we follow Ireland and we start looking at capital acquisitions tax, because the inheritance taxes have been hollowed out in the UK and in the US, for example. Rather put it onto the person getting the asset, and then fine, if there's a trust there, we have what the Irish have done, which is tax the trust, 6% on assets entering the trust, then 1% every year. So let's not reinvent the wheel. Let's see what other country of similar size has done and follow them. So that was the main things that I was looking at. One thing I would say, it's not just baby boomers. The silent generation, the generation that came before that, amassed huge amounts of wealth. So, as you're saying, it's going down by generation, and each time it's creating this wealth inequality as it goes down. So there's at least 3 generations of that, and it should be in the person who receives it and taxing them properly. And then finally, just in terms of my comments, trust register, as long as we agree in principle, then the details can be sorted out later. So the French case that Terry mentioned, the constitutional advisory body did not say you can't do it. They said it's the degree of intrusion of privacy that does matter. So it wasn't actually opposition to a register. So we need to get that right. And I do think the analogy that you drew, Ed, with the company's registers there, I think it's really important that people should know that, perhaps is this property, identify this property. And then if I go to that, then I may not do business, just in the way that I may not do business, if I know who the directors of the company are, I know who the shareholders of the company are. So as long as we do agree with that in principle, then we can sort out the details down the line. So yes, I'm sorry for not disagreeing with you, Terry. But I think it's really good that coming perhaps from different directions, we're getting a fair amount of consensus on this.
Yeah, perhaps it might not make the tabloid newspapers for that reason, but I think it is good to have some consensus on these issues. Terry, did you want to respond to anything that Jonathan has been saying?
Jonathan raised the point about residential care subsidies. And that actually was a huge driver. I mean, the legal industry in the 1990s deserves a round of applause by how well they marketed trusts during that period. And one of the common things, there were two ways they went about it: asset protection, but a lot of it was to do with residential care subsidies and avoiding that. And that graph that shows the explosion in number of trusts after the end of estate duty reinforces that. But MSD got across that. And in reality, that is no longer an avenue that was closed. It has been closed off, certainly basically since 2000. But still, it's a good point. The other point, and this is really very interesting, in actual practice, as Jonathan, and touching on Jonathan's really key point about the potential of creditors avoid protection and avoiding liabilities. In other words, a company or your business falls over and you owe inland revenue. This is a very common scenario, and creditors $1 million or so, and assets are held on trust, and that means that you can't get at them because they're leagued separately. So the inland revenue may has a means of taxing that. In actual practice, the consequences of that is inland revenue or other creditor will make that person personally bankrupt them, and then they on that. And legal practitioners have told me, when push comes to shove, very few are prepared to have the stigma of bankruptcy. And in many cases, they actually dive into the trust to make some form of settlement. Now, that's an interesting reaction about the stigma of bankruptcy, but it's still, and it sort of semi-addresses Jonathan's point, but still, there are people who will simply say, well, no, make me bankrupt, so what? I've still got my house in Paranui and all the rest of it. But so the actual practice sometimes is a bit weird on that. It's one of those things where the social stigma still works. And then means testing is going to be important, as if we get to, we have a lot of testing going on at the moment. So I'm a bit amused when people say, oh, well, means testing superannuation could be very complex. I'm thinking, try talking to a beneficiary about means testing, or someone working for families, or student allowances. So they're highly complex matters. So it's nothing. And the final point about capital acquisition tax, and I think this is something we should all keep in mind. We're not reinventing the wheel here. Everything in tax is not new, in my view. There are other jurisdictions that have dealt with it. And you probably just look at the US and the UK for the two of the longest established tax systems in the world. Any issue we would encounter, they already have. And so they would have had some response to that. The Irish example of capital acquisitions tax, that's where the donee, the recipient, is taxed, not the person giving it away, as an inheritance tax, is something that's starting to gain traction. It's worth looking at. It's not without its complexities, but no tax comes without its complexities.
Of course.
Sorry, just on that social stigma, Terry. Again, the psychological aspects of the capital acquisition tax is shifting in a way. There's no more arguments about death taxes. Here's money that you haven't earned. You've done nothing except the accident of birth, in most cases, in order to inherit.
Yeah.
Which is why I've been banging on about this for years now.
One question that's come through, what changes would you ideally make to the Trusts Act? Either of you can answer that.
To some extent, we're still having a bedding in process with the Trusts Act. I mean, it's actually been in force for just over 5 years. And so some of the changes are still shaking down there. The one thing that is definitely happening is the number of trusts is falling. People are looking at this and saying, no, we don't need these anymore. I guess the Trust Register would be an adjunct of this Trusts Act. But a lot of work went into that. That was a 10-year project to get done, and I think the laws codified it. The key thing that was caused a great deal of exercise, and Jonathan, you may disagree, may have a different view on this, is this question of trustee disclosure. That's made a big difference, more than anything else, and that trustees now have to disclose to beneficiaries what's happening, and it's probably, for want of a better word, limits, to put a limit, or started limiting the shenanigans that go on. And this idea, partners in relations may be hiding assets and trusts without the other partner knowing anything about it. There's so more cards on the table is happening as a consequence.
Yeah. Yeah. Look, I mean, I'd always go back to draw the analogy with the Companies Act. They're very similar arrangements, and companies came from trust law, and one has kept this incredible flexibility, and one has a much greater oversight. I think we need to see much greater oversight of trusts.
Yeah,
right. I think that's a good point. We've had a few comments from John Kenton. I like this one. If MP accommodation allowances followed the same rules and processes as residential care subsidies, there might be an improvement to both. Any thoughts on that?
Well, that was a good question just pop up. Yes, I'll deal with this one from Noel in a second, because I still have to deal with UK tax. Yes, you do wonder. I mean, it's a classic example. Sometimes you look at them MPs, it's don't do as I do as I say. And that's, yeah, I think.
Especially when they're
probably, John, it was a flippant comment from John. And I think, but it's also a valid point. Why are those rules different? If someone was trying to claim accommodation allowance or who wasn't an MP, and that came up, oh, you've got a property in Wellington already, so why are you claiming this? I'm entitled. Doesn't really cut the mustard. Now, someone's just asked about UK's inheritance tax does not apply to lifetime transfers except within transfers of a few years before death. Not quite is the answer to that. A bit of nuance, to borrow Jonathan's phrase. Transfers to trusts are what they call immediate lifetime transfers. So if you make a transfer to a trust, that is immediately chargeable for inheritance tax purposes. You've got a nil rate band of £325,000. But if it goes above that, then the excess is liable to a lifetime transfer at 20%. So there is that thing. But the other thing is the gifts, as Noel was saying, if you, it's called a potentially exempt transfer. If you make a gift for inheritance tax purposes and you survive 7 years from the date of the gift, then the gift falls out of the estate. But that's just a wee nuance. Thank you for that, Noel.
Well, I think a lot of people in the UK are prepared to take that gamble. I've certainly heard of them offloading their property when they think, well, I've got 7 years to go. I'm going to get rid of it now.
Yes.
And again, capital acquisition tax, we get rid of that game.
Capital acquisitions tax is really quite interesting. It's sort of the Green. I noticed what the Green Party, just on that, I saw the Green Party's moving with that suggestion, and then I looked at the numbers of what they thought was coming in, and then compared that with what Ireland's revenue, and they were roughly very comparable. Ireland's getting something like €1 billion a year, which is more than one, about no, a bit more than 1% of its tax revenue from capital acquisitions tax, which there's still some form of death duties do apply. So yes, it's gradually that will increase over time. And as you say, Jonathan, how can you complain about it? You did nothing except an accident of birth.
Yeah, fascinating stuff. I think we're probably coming towards the end of our time today. So I'm going to take a moment just to thank Terry and to thank Jonathan for your incredible contributions. I've certainly learned a lot. I'm definitely going to restructure my affairs immediately after this discussion to keep. But I think there's a lot for us to work with there. A lot for us in terms of tax justice Aotearoa to be able to continue to push the mission, greater transparency, and to use that to drive a bit more revenue to deliver better public services for our community. So thank you, gentlemen. Thank you to everyone who's joined us on the stream. We've been very grateful for all your questions, all your interest and involvement. And please remember to get involved in the campaign. There's 3 things you can do right now. 1, sign up to get involved via the link in the chat. Please, if you want to do a bit more, then fill out the volunteer form, and then for those of you with a bit of extra floating around in your trusts, then please consider making a donation to the campaign so that we can keep delivering this kind of mahi to all of you guys. So thank you so much. We will email you through these links and also the webinar recording. And please join us next week on the 28th of July, where we're going to have another session, this time on corporate tax with our residential expert, Nick Miller, no relation to me. And we've got 2 more sessions coming up in the series in August as well. So please sign up to our mailing list and you'll receive notifications to these. And thank you again to Terry, to Jonathan, and to all of you for attending.